Good evening and welcome to the ShadowTrader Video Weekly for Sunday, February 27th, 2022. So, first things first, you are hearing my voice behind this screen, but obviously you're not seeing me standing up in front of my big interactive television touchscreen. I will be back to that next week. Apologies for not being able to do that video this week, but I will be definitely back to it next week. However, I do have a lot of really good content for you this week, and I hope you do enjoy it, even without seeing my smiling face in your video. This video is going to be dealing with answering the important question that must be on every trader's mind right now, which is the low in? Meaning the low of a couple of days ago. I'm recording this on Friday evening, and we're talking specifically about this area right here, and the question is, of course, is the low in, meaning Thursday's low. And in this particular video, I'm going to start by giving you 3 factual reasons as to why I believe the potential for the low is in. It's starting to feel like, to me, like the low is in, and I am starting to comport myself accordingly, trading more from the long side, which I have not been doing for a while, as the market has been falling for a while. And I think it's important to note before we get into it that I stress how the things that I'm going to talk about are factual, and they are actually better labeled as what I call market-generated information. And this is very, very important. You may have heard me talk about this before. And it's extremely important because what I'm going to talk about is information that is generated by the market, which means that it is things that the market has done that have actually happened and are readable on different types of charts and are not my opinion. Okay, so it's not talking about things like, well, the Ukraine invasion is not going to be so bad for markets, or now the cat is out of the bag and the Fed is being very transparent and everybody knows we're going to have a rate hike in March, so that's the reason why the market is rallying now, because it already sold off on the rumor of the rate hikes, and now that we know. Do you see where I'm going with that? None of that is information that's actually generated by the market. All of that is just opinion. That's just fluff. You can't really back that up with anything. So as you know from these videos and my analysis and my advisory and everything I've been doing all these years, I don't deal in that sort of nonsense. I don't traffic in that. I traffic in market-generated information, also known as MGI. All right, so let's get into a little bit of it right here. Okay, so the first potential reason why the low may be in is simply trend. And trend, as I always like to say, is absolute. There is no opinion or maybe to trend. Trend is either in effect or is broken. And we're starting to see downtrends be broken. In this S&P cash chart that I have here, this is the S&P 500 cash, we have a primary here. This is our primary downtrend, so we'll label that one as a P. And then we have a secondary here, which is a little bit closer to price. You can call that one S. And you notice that in Friday's price action, we now have broken it. Okay, so obviously we are still in the main downtrend. Market is still in a downtrend, but there has been somewhat of a changing of the guard here as we have started to break trend, and this is important. So going forward, what are we looking for? Potentially the market could head up to this 20-period moving average or a little bit even higher to where the primary downtrend is. Okay, so trends are starting to break. That's point number 1. That's the first piece of MGI that I'm going to present. And before we move on, let's look at the NDX, NASDAQ 100. Very, very similar situation where you've got a primary here, and then you've got a secondary here, and we have just now started to break that. And could we go a little bit higher up into the more dominant trend line that is above? We shall see. All right. Second piece of MGI that I want to talk about, which is backing up my thesis that we have potentially put in the low on Thursday, is the pattern in the markets. Okay, and this is really a little bit more nuanced, but still market generated information that we can look at, and of course absolute, as the chart pattern is the chart pattern. However, a little bit of a caveat: how individuals interpret the chart patterns can be different. So I'm going to give you my assessment of what I'm seeing in pattern, okay? I've been talking a lot about what I call the H pattern as the market was coming down, and that's this, where the market forms the letter H. And if you look in the ShadowTrader.net glossary, there's a link to it at the footer of our site, you will know that the H pattern stands for hell for shorts, meaning that many shorts come in at the low thinking that it should go lower, and then it never seems to work for them. And this H pattern was slightly different than most in that when shorts broke the low, they did get paid for a little bit in half of this session, a short period, and then they got paid on the gap down, which is when the Ukraine invasion happened, which is the Wednesday to Thursday night move down. However, notice what the market did since then. This is very, very important because it sets up the pattern that I'm about to talk about, is that we rallied extremely hard from the lows and never looked back. And in doing so, we created something called a piercing pattern. And a piercing pattern is when you open up below a bearish red bar and you move up hard and you pierce into that bar and you close up deep in it. And as you can see, the bar on Friday closed very, very deep within it. In the NDX, it closed almost at the high. And if we flip back over to the S&P, it is very, very similar. It's basically the same exact thing. So you have these two major markets that we watch very closely, and they're both exhibiting this piercing pattern, right? This one didn't actually go as high up in the range, but took back enough of it that it is a piercing pattern. And piercing pattern is a relatively rare pattern. And if you want to get really technical about this, there's a gentleman out there on the web, his name is Thomas Bulkowski, and he wrote a famous book called Encyclopedia of Chart Patterns, and you can look up some of his statistics on the web that he talks about in his books, and the piercing pattern actually follows through in a bullish manner 64% of the time in the tests that he ran. Obviously, he's probably not looking at every single example there is. I don't know how large his set was, but he gives different percentages as to how these things play out. I'm not really hanging my hat on that 64%. I'm just mentioning it as an aside because you may find it interesting, and I kind of respect that guy's work. I think it's somewhat noteworthy. Not a lot of people have taken the time to go through all of that, and I'm a big believer in chart patterns myself, so it's something you may want to check out. But regardless, even without knowing those statistics or bringing those statistics into the mix, we do have a very classic piercing pattern, and it is a relatively strong reversal pattern. Now, when speaking about the pattern, what we're seeing here in terms of this advance, it definitely bears mention that it is extremely different from this one. And I'll tell you how it's different. Notice that when the market started rallying here, it broke out of this consolidation pattern, but when it broke out from the low here, it did not make a new lower low. This consolidation pattern was really just working off the froth of this entire down move, and then as you broke out through the top of the consolidation, you basically had a little bit of short covering moving up, but then the market, you can see, fell back down. This pattern here is very, very different in that the explosive move to the upside came on a capitulation, meaning that on an overnight move in the futures on the bad news that came, the market reacted very negatively to that news. Futures were down about 100 on the S&P. They were more than that at the lows, but opened up around down 100 and just took off from there and started rallying. So be aware, that is something that is important and it is different. And I also put a little bit of weight on the H pattern in the fact that this lowercase h, as I say, it's usually hell for shorts. It never seems to work. Whenever anybody gets short below the low of an H, it never seems to work, and it usually brings in a lot of short covering, and that is what we are seeing right here and right now. Now, while we're on the subject of patterns, and we've already discussed the piercing pattern and the H pattern, both of which I think are important in supporting my theory that the low may be in. The other pattern that I ought to mention, and this is one that you won't generally read about anywhere else. I think I'm probably one of the only people out there who talks about this pattern. And it's a pattern that I call sellers shut off. And what sellers shut off is, it's a type of very bullish bar that basically takes out multiple bearish bars that preceded it that actually had a downtrend. So for instance, this bar here is not really a seller's shut off because you're not in a downtrend here in the 2 bars that preceded. It just kind of negates the 2 bars that came before it, but those bars were not in a downtrend. But when the market is in a downtrend and you start to take back multiple bars, like for instance, in this case, you take back in this 1 bar on Friday, all of this, that is a form of seller's shut off. Now, I will be honest with you, it is not perfect. Oftentimes sellers shut off can and should be more violent that and take back more of it. But later in the video, I'm going to show you a couple of sectors that I think are poised for gains here, and you will see that. And those sectors are relatively, somewhat, they're important in the S&P, I should say. They're 2 out of the 11 S&P sectors, and you'll see a more classic example of sellers shut off. But this is, for all intents and purposes, a decent example of it where you're starting to see one day take back bearishness of multiple days that was coming down. That is a very strong sign to me. Again, it's a relatively rare pattern. I point it out to my subscribers all the time whenever I see it. Oftentimes when you see that pattern, what it basically speaks to you is it says that whatever the low was that preceded that pattern, those lows are usually secure, meaning that they're not going to get taken out anytime soon. All right, let's move on. Number 3 in this section is market profile and the concept of WWSHD. These 2 things go together hand in hand. WWSHD, of course, stands for when what should happen doesn't. And as you know, I'm a big proponent of market profile, and I talk about this all the time. I write a report every morning that I really believe everybody should take at least a 5-day free trial to on our website called Peter's Pre-Market Perspective. And one of the things that I look at, and this is really kind of how I judge futures markets as they trade during the day and both intraday and in the bigger picture, is I look for scenarios and situations where I know what should happen on a theoretical basis, meaning we know that price should do this, given the pattern or given the market profile pattern, where the volume distribution is, where the time distribution is, et cetera, et cetera. We know what should happen. And when what should happen doesn't, that is a strong signal that the opposite is happening. So there were some things in the market profile, which I'm about to show you, which spoke to me this week, that were showing some things that should have happened that didn't and turned out to be bullish. So first things first is that this is Thursday here where the market reversed off of the overnight low. And you can see here, this is the overnight low here all the way to about 4,100. And then the market opened here at this little green dot, which I don't know if you can see it, but there's a green dot there. That's where the market opened. As you can see, it was off to the races, and the market, had the huge day on Thursday, which is the reversal day. So the question is this low in? And again, we're talking about when what should happen doesn't. So let's just move the profile a bit higher. And you can see that on Thursday, first thing I want to point out is that the POC did not migrate higher. That's bearish, but just one data point. But in market profile theory, we think of that as bearish because the fairest price to do business, where the most volume traded, either by volume, which is this 41.75, or by time. You can see how all this distribution is very fat. Each letter is a 30-minute period. So as they go across to the right, that tells you that many different 30-minute periods all traded in this area. Notice that it is low in the distribution. It did not move up. So that tells you that value remained low. And when value remained low, the market started to really advance on Thursday hard into the end of the session. And we call that a spike. When you go up like this, it is a spike, okay? This is important. So what happens then is we then look to see, is the market going to accept the prices of the spike, meaning that will the next day open within the spike, which is bullish because these higher prices from late in the day have not had enough time to be accepted because time ran out. These higher prices happening at the end of the day, and the bell rang, and then we don't know if these prices are just a fluke or if they're here to stay. So we would expect that at least some of those prices would be retraced the next day. But as I was saying, when what should happen doesn't, notice that the base of the spike here was taken out. The spike is really just this top level here. I know that I drew the whole thing, but really just the kind of the end of the day, like the last two periods here are the spike. Notice that the spike got taken out in the overnight session, okay? But at the same time, there were some single prints here, which is it's kind of like a daytime spike where you can see things got really emotional and people were just hitting the buy button like crazy, and none of that got retraced. So my first signal that I thought we could be bullish on Friday again was the fact that the overnight activity didn't come all the way down to where it should. Again, when what should happen doesn't. Why didn't it retrace this area, since this area is kind of like a gap? It's like a price void. There's no value there. You can see how little volume traded as well. If you look at the profile here close up, look at how low the volume is. I mean, 67 contracts, 50 contracts, 79. This tells you that absolutely no time was spent at these prices. And the market generally doesn't like these areas of low volume. Markets like areas of higher volume where more two-sided trade can be affected, and the market looks at that as value. And the market is basically always just moving towards areas of value or doing price exploration and then establishing areas of new value. Okay, that's basically the market's MO. That's all the market is doing as it is fulfilling its number one mandate, which is, of course, to distribute financial instruments, be they futures contracts or shares of stock, to the greatest number of individuals in the most efficient manner as possible. All right? That's all the market is in a nutshell. Okay, so anyway, we don't go down to all the single prints. We have this overnight session, and then look what happens on Friday. Where do we open? We open on a true gap higher way up here at the green dot, 42.98. And as I was telling everybody in my pre-market perspective on Friday morning, I said to everybody, I said, this day is going to be all about, and we'll call this Thursday high. This day is going to be all about how much do we retrace into the spike and into Thursday's session. And again, what should happen if there's not a lot of value here and they bulled it up into the close and the point of control and the value area didn't move higher, technically you should fall back into that. Those prices are not fair. And yet, when what should happen doesn't, the market thumbed its nose at that and rallied hard on Thursday. It came down a bit, only this far into the range. So think about it. How little of Thursday's range got retraced? Very little. Came back to its open, and then again it was off to the races, and you moved up again. And in doing so, you created this pattern on Thursday where value was much, much higher, right? Not overlapping to up, but breakaway clean to the upside. That's bullish. Where was all the time spent on Friday? In the upper reaches, not in the lower area. Where was the most volume traded? All the way up here, close to 43.80. Okay, so all of this is market-generated information that I'm getting from the profile, from when what should happen doesn't, and the footprints of the money, so to speak, that have been left on the futures chart that tell me that things are happening here, that the market is actually, not caring about going back to value, not caring about the spike, having the most bullish outcome of the spike. We have spike rules whenever we're faced with a spike. The most bullish outcome of the spike is to open above the spike and not test any of the spike. So this tells you very importantly that even though prices were so strong on Friday, they did not auction high enough. Even with the spike, they didn't auction high enough to cut off buying activity. Remember that. That is what happens when markets turn at highs. I've said this a million times. Genius sellers who are selling at the top, they don't exist. There's no such thing. There's a few here and there. There's a few people who know how to pick a top. They're short-term traders, they're scalpers, whatever. I get it. Markets turn because buyers run out of bullets. Markets turn at the bottom also because sellers run out of bullets. There's just not enough of them there. And then the natural buying just takes over. Okay, so this is very, very important. All right, so anyway, these are my 3 reasons, if we look at it, as to why I feel that there is potential that the low actually is in. So to recap, 1, you have trends breaking. 2, you have patterns that are relatively rare and important, such as piercing patterns, sellers shut off. And 3, we have the market profile and when what should happen doesn't. Okay, let's continue on with some sector analysis. And this portion is not really like part 4. I'm not intending this to be more support for that the low has potential to be in, but in a way it kind of is even by itself, because remember, the sectors that I look at are always only the 11 sectors that make up the S&P. I don't get any more granular than that. I'm only interested in financials, healthcare, energy, materials, consumer staples, consumer discretionary, industrials, real estate, etc. The 11 sectors that make up the S&P, they're the only ones that I am really interested in. And I'm just going to show you just a few. Look at healthcare here, which is very heavy weight in the S&P. And remember, we talked about that sellers shut off pattern. Well, look how many days here got negated just by Friday, and they were in a downtrend. So again, you have to have a downtrend, and you need multiple days to be inside of one day. Again, that is sellers shut off. The sellers that created the downdraft are essentially, or have essentially been shut off, and the move after that is technically to the upside. And look what happens here on the trend. Where is XLV? Where are healthcare stocks in relation to trend? And mind you, this is the primary downtrend, not a secondary downtrend like we were looking at in the majors. This is the primary, just a little bit higher here in healthcare, and healthcare is now back in an uptrend. All right, so remember that. So that's important. So you can look to this sector for potential opportunities as well. Let's look at a couple of others. Consumer staples jumped out at me when I was looking at it after the market closed today on Friday. And it's a very, very similar situation where you have primary downtrend. And here, it's not even like, I mean, it is a seller's shut off really, because in theory, we can, and I'll just draw this as in red. Here, look at this. This gap here is really a red candle. It really is a red candle because prices moved down there, opened down here, and then there's just did this. So again, are there multiple days that are being negated by one day? Absolutely. So you have a seller's shut off pattern there. So staples might be an area to look at as well. And that's a decent weight in the S&P. I think it's about 10 or 11% of the S&P just in staples, right? Last but not least, look at materials here. Not that heavy of a weight, but bears repeating, or bears mention, I think, just to show you the pattern where I just wanted to show this, that I found it interesting that there are almost 4 bars that are taken out by 1 bar. And again, this is sellers shut off, relatively rare pattern that I look for. And in these material stocks, look at how much of it in 1 bar. You don't see that all that often. So keep that in mind. That's where there could be some opportunities to look for. For specific stocks, I'm just going to leave you with one, and it's really probably my best idea for next week. I haven't done anything with it because I really just found it after the market closed today. But within the XLP, which is consumer staples, one of the stocks that is a component of that consumer staples index is Costco. And look at this pattern. This is just fantastic. I found this very, very interesting, that this did not make a lower low at all. Here's the low was put in here, did not make a lower low, gapped down with the market, rallied, and now you have this shelf. Now I'm going to look at this day here as an anomaly, and I'm just going to kind of ignore it because I'm just going to look at these days here, how equal they are. Look at how equal this is. This is what I call a shelf because it creates the prices bumping their head all in the same area, creates a shelf. Plus you have this 50-period moving average. So I'm thinking we move over there. There is potential, I think, for an up move. Earnings are going to be coming on March 3rd. So there's a little bit of time before earnings. As you know, I generally don't like to be in stocks on earnings. That's going to happen on Thursday of next week, but you've got a little bit of time here. And if you're confident that those numbers are going to be good, maybe you can hold through that. But regardless, when I see a pattern like this is something I would be interested in, where the downtrend kind of failed, sellers got stuffed, and you're back up to a little shelf area. And there you go. And again, XLP as a sector, and these stocks generally also move with their sector, very, very strong right now. And last but not least, I wanted to wrap up this video with a example from today's trade, today being Friday, February 25th, example of the weighted AD, which you've heard me talk about. This is the new ShadowTrader script that we've come out with, which is an absolute game changer, I feel, in terms of keeping you on the right side of the market and confirming when changes in the market are coming. It does many, many things, but one of the things that it does really powerfully is confirms trend changes. And so I want you just to focus just on these two charts here, which is on the right side of my quad. And this is my weighted AD here at the top. And I've got it set to a 5-minute. And I've got the SPY set to a 15-minute. So they're not exactly matched up. But you can see here, obviously, that this is where Friday begins. And obviously, the initial part of the day was a little bit bearish for the first 30 minutes. So that would be, of course, this activity here. And obviously, the market was having difficulty getting lower. And if you understand market profile, and preferably if you are reading my pre-market perspective, you know what to look for, because I give you scenarios before the market opens. And, you know, we're talking about things like we want to be cognizant of whether or not we move into range or not. And as I discussed earlier in the video, we moved into range only very gently, a little bit, came out of range. But notice how well this indicator really confirmed that the trend change was underway from bearish to bullish early in the morning on Friday by signaling to us when the weighted and unweighted sectors went positive. So look at your 15-minute chart here on the S&P, and you can just draw a trend line like this. And obviously when the trend breaks, you're now moving to the upside. And there's obviously a huge move in that lasts quite a bit of time. And again, 15-minute, 5-minute. So if this is on a 15-minute, let's just mouse over and look at the exact times. This bar is the 10 a.m. to 10:15 bar, and it just makes it to the top of the trend line. And here's where the move really starts, which is the 10:15 to 10:30 bar. And look what happens here. Mouse over the times, and you can see them right up here. Look at when we go positive. Exactly 10:20 a.m., which ties in perfectly with the breakout here over the downtrend line. At the exact moment that you're breaking out technically on the S&P, it just so happens that the sector readings here of the weighted and unweighted sectors, remember the weighted is the white line, or the unweighted, excuse me, is the white line, and the weighted is the histogram. It breaks out from negative to positive at the exact same time as you have the trend line break. And then as you can see, it's off to the races. And look at how it closes, how it trades the rest of the day. Absolutely just stays really overwhelmingly positive, everything above zero, etc. Okay? And this is the type of stuff that I'm pointing out as it's happening to my subscribers. This is everything that happened on Friday, and I just wanted to point out some of the timestamps of when I'm saying this stuff to my subscribers and what exactly I am saying to them, which I think is important. And again, you can see here right off the bat, 9:05 a.m. before the market even opens, I'm saying please read everything in the pre-market perspective, because it was a very accurate and honest assessment of what was happening today and what we need to be on the lookout for. Talking about the spike, talking about how deep do we come into range, etc., etc. But more importantly, I'm talking about all of this market generated information as it's happening. So again, timestamp 9:53 a.m., about a half hour before it breaks out, I'm saying the weighted is reading exactly as you would expect, only slightly negative. And I was trying to point out that it wasn't really firmly negative, that the market was just kind of being sideways to down early, right? Next Alert, 10:04 a.m. I'm already expecting that there's potential that we move back out of that range. And again, what am I saying in real time? If we go back out of range, because we've come into range, that is a bit more bullish. I am watching the weighted AD to see if the readings can get positive. That would be solid confirmation that the market can move higher. And again, when did I say that? 10:04 a.m., a full 15 minutes before this is actually happening. Okay, then I'm looking at trend line in the NDX, pointing out that if we get a trend line break, this is a 24-hour chart of the NDX. If we get a break, then it happens, and then boom, changing the guard. I say right when the moment that we start to get the first green shoot above, it's right there basically. And then what happens as soon as I get that confirmation? Well, you know me, I'm back to my old tricks again. Selling puts in Amazon is like the first thing I'm thinking, because it's just the easiest play that I love to do. And I'm just right kind of back on the more bullish bandwagon. As you can see here, I point out a very interesting chart pattern in Facebook in real time at around 11 a.m. as Facebook daily starts to break the downtrend and then start, little by little getting into more bullish play on Facebook as well, looking at selling some puts down here below support, being a net seller. I mean, you have an unbalanced butterfly, and then by the end of the day, kind of confirming that, getting into a little bit more debit situation, actually buying a wide butterfly in Facebook. So I'm just kind of giving you an example of how I bring this type of market generated information to my subscribers every day in real time as it's happening. If this isn't salient, actionable information, then honestly, I don't know what is. But anyway, I hope you can join me. This is the weekly options advisory, which I do every single day. Check it out on our website under the options tab. Okay, last but not least, the weighted indicator that I just showed you. Okay, it is available on our website. That's under the stocks tab. It's called the weighted AD, but recently it has now been developed for TradingView. A lot of people on TradingView, so we now have a version of it here on TradingView, and you can just check it out at this site, which is technimentals.net, and I'll just write it in here so it's easy to remember. It's technimentals.net, and you can get it there. It's the same exact price as ours. Here's an email address where you can ask some questions. But again, if you happen to be on TradingView, you can go to this website here, technimentals.net, and you can get the weighted AD, which is just like the Thinkorswim version that we are selling on our website, and you can get it for TradingView if you like. All right, let's just recap a little bit what we were discussing in this week's video. Again, the title of the video is the low in, which is of course very apropos because everybody is probably wondering the same thing. And remember, as you go through some of the data that I've shared with you in the video, understand that not me, not you, not anyone can know with 100% certainty what is going to happen in the market. All you can do is be an odds player. I always say that the market is really just about odds. You just look at different situations and scenarios where the odds will be in your favor, but those odds are never guaranteed. It's not a lock. It's not perfect. It's just that it's more skewed in your favor. In the trading world, we call that edge. And in the market currently, as I was discussing, there are three main factors of market generated information that to me are pointing out that there is pretty strong potential that at least a short-term low for now is in. So again, just to recap, we have a break in trend. That's of course the number one reason. It's the most important one. Secondary trend lines at least are starting to break, and they're coming from a lower low, which makes them different, I should say, than when this trend broke, because it wasn't coming from a lower low. Here the market actually made a lower low, and that's important because it implies capitulation where people are throwing in the towel at the wrong time. So that's point number one. Point number two is that you are starting to see some exhibition of sellers shut off pattern and also the piercing pattern, which we saw. And the piercing pattern is relatively rare. Again, as I mentioned, about 65% probability that it follows through. Relatively rare pattern, and is, a pretty strong reversal pattern. And last but not least, we also talked about market profile and the concept of when what should happen doesn't. And both the market on the market profile, we saw some very key things happen on Thursday and Friday where the market easily could have gone lower. It had set up there in terms of pattern and distribution of price and time and volume where we could easily have gone lower and retraced some of that very emotional upwards activity, but we did not at all. So it's like a when what should happen doesn't. And also some of those other nuances in the profile, as I was showing you, where value was so clearly higher on Friday, and you did get that point and control migration up to the upside. So it did seem like there was a changing the guard. My mentor in the market profile, Mr. Jim Dalton, always says that traders should not trade price, they should trade value. And that is very, very true. Where value is in the market is far more important than when price is, and it's much more indicative, I think, of where prices are going to go in the near term. All right. If the markets were to reverse next week, before I speak to you again, it's probably a good thing to talk about where would I think that maybe this is not working out and the low isn't in. I would keep it simple and basically just look at a Fibonacci retracement of this move that we just saw off of the lows. I would just take a fib and just place it right on the low and bring it right up to the high. And you can see we could come all the way back to here and have a 50% pullback. Now, the fact that we've broken this secondary trend line and we closed a daily bar well above it, that in and of itself makes it harder for the market to come back down below trend. So just be aware of that. And then, of course, if things work out as expected and we get some follow through, the simple target for the market would have to be the primary downtrend line. And then we reassess the situation from there. And of course, there are a couple of key moving averages as well above us, which actually should act as magnets. We should kind of expect that the market might get pulled towards that 20 and 200, which those are. The green line is a 20 period simple and the blue line is a 200 period simple. And that's also just ahead of us. So let's keep that in mind as well. All right. That's all I have to share with you this week. Thank you so much for spending a little bit of your weekend with me. Again, apologies for not being in front of the camera this week, but I promise I will be back on that next week in the studio with the more long form video with the camera and the TV and everything. But in the meantime, from everybody here on the ShadowTrader team here in beautiful Philadelphia, Pennsylvania, as always, I sincerely wish you good trading and good night.